Stock ticker RTX, known as RTX Corp, is enduring a bit of turbulence this week as the stock dipped over 7% on Monday. Shares navigated through a bumpy trading day, leaving some market watchers wondering if it's just a momentary dip or part of a larger descent. If you don't know what RTX Corp is, they are an aerospace and defense industrial company for commercial, military, and government customers. In an earnings call on July 25th, the RTX Corporation announced its intention to begin an accelerated inspection of at least 1,200 recalled geared turbofan engines, which are manufactured by its subsidiary engine maker Pratt & Whitney. The culprit of the recall stems from microscopic contaminants discovered in powdered metal used for the engine's Stage 1 and 2 high-pressure turbine discs manufactured between 2015 and 2021. The impurities in the powdered metal exposed the disc to risks of accumulating microcracks in advance of their specified service lives. The flaws were first detected in a broken disc on a Vietnamese A321ceo airliner using an older turbofan engine. However, in mid-July, Pratt & Whitney decided that they weren't comfortable assuming the risk posed by the contaminated powdered metal was limited to its older engines and that they needed to inspect all engines that could have been impacted. RTX began the recall with plans to inspect 200 of its oldest higher-priority engines by September of this year. An estimated 1,000 more engines may require inspection in the year to follow, though the final number could end up below or above that depending on the findings of the initial wave of inspections. The 1,200 engines potentially impacted amount to 40% of the roughly 3,000 GTF series engines delivered. RTX's executive Greg Hayes conceded during the July earnings call that the disappointing problem would be expensive to fix and would impact customers, though he insisted that it didn't amount to an existential problem for either Pratt & Whitney or RTX. While existential or not, the recall reportedly affected 11% of airliners using the GTF series engines. Planes were either grounded or flown only once per week. There were many delays, either caused by waiting on spare parts from Pratt & Whitney or by waiting for slots to free up for engine inspections at limited maintenance facilities that support these massive engines. Inspections for the engines aren't exactly a quick looky-loo either. The engines need to be taken apart to reach the potentially impacted discs. Earlier this week, RTX provided an update on the impact of the recall. RTX cut its full-year sales outlook and will take a roughly $3 billion charge in the third quarter tied to the plan to address the flawed parts, which will involve compensating airlines for the disruption to their operations. The impact to RTX's pre-tax operating profit will be as much as $3.5 billion over the next several years. The company now expects reported sales of $68 billion compared to an earlier forecast of around $74 billion in adjusted sales. The majority of the incremental engine removals required by the fleet management plan will occur this year and early 2024. The largest operator that will likely be impacted is India's Indigo airline with 143 aircraft. Other major operators that will be impacted are U.S. airlines such as Delta, JetBlue, Spirit, United, and Hawaiian. The $3.5 billion financial hit was larger than feared after the company earlier estimated that the first 200 engines needing inspections would reduce free cash flow by only $500 million this year. The silver lining of this recall, if there is one, is the willingness of the company to take on the cost of preemptively identifying risks, even if they expect to find flaws in only 1% of all engine discs. Despite the massive costs and adjustments in the company's outlook, is the stock now trading at a discount? Taking a look at their price to operating cash flow ratio, we can see that it is a bit high when compared to the industry average of around 18. Another multiple that we see as high is their price over free cash flow to equity. This ratio is a valuation multiple that compares a company's market cap to the amount of free cash flow available for equity shareholders. The industry average is about 46, but RTX is trading at 106. Analysts typically prefer POCF over PE since earnings can be more easily manipulated than cash flows. That said, the median PE for the industry is currently sitting at around 27.5, and RTX currently has a PE of around 20. Looking at the weekly chart, the stock pretty much gapped below the support at 80.50 and closed below it. The next major support level is this double bottom dating back to 2019 at 72.60-ish. The bad news and downward pressure from sellers could easily send this stock back to 2019 levels. The PE ratio at that time was around 18 to 20. With the PE currently sitting at 20 on the higher side, there is some room for this stock to drop before it hits value territory. Well, that's all for today's video. Let me know if there's any stocks you'd like me to cover next. Don't forget to hit like and subscribe if you enjoy this type of content. Thank you for watching, and I'll see you in the next one.